Okay, before we head in today, Costa Rica Seminar Week. A couple weeks ago, I said I'd be opening up November, 2 weeks in November, November 16th to the 22nd, 23rd to the 29th. This is completely booked the last week in November, and I have only one spot left on the 16th to the 22nd. I know it's short time. It is November the 2nd today. This is in 2 weeks from now. But if you're interested, just send me an email, meldrum.b.m@gmail.com. Okay, there it is. And there's only one spot left, and it's really the first to confirm that we'll get it. Discord, if you are a subscriber to the applied level, you have access to Discord. Did this last week, just to remind you, a Sunday 6:30 p.m. We have our 30-minute to 1 hour Globex live session, which is a weekly preview of what we can expect for the week. Here I'll outline a trade on MP Materials and on another energy tech company that I've been looking at as well. They both report this week. Tuesday, 8:15, 8:45, we've started the morning briefs. This is a daily preview. It's 15 minutes to half hour in length. That's it. By Q1 2026, we'll be doing 5 days a week on this, but we're sort of just tapering ourselves in. Starting next week, it'll be Tuesdays and Thursdays. That'll go for 2 weeks, and then I'll add a third day, and then 2 weeks, and then another day, such that by the time we get to the beginning of the year, we'll be doing this 5 days a week. The space is I use a stage. It's called just a stage presentation. I'm allowed 300 people in the audience at any one time. I got to boost the server, and every time I boost the server, I get another 30 in here. At some point, it's going to become too expensive to keep boosting that server for the amount of people that are showing up. So I may have to change the venue to on the site itself using Vimeo, which is not my favorite thing to use, but boosting the server at some point will become prohibitively expensive. I may just I may have to do something there. I don't know what, but right now we're not in any danger because I can keep boosting this. This is, I think it's like $35 a year for every 30. Okay, let's head in. We'll start with the Fed decision from this past week. Early in the morning, we got Bank of Canada. They cut 25 basis points as well. And sort of as a preview to what we heard from the Fed, the governor of the Bank of Canada said pretty much the same thing. Don't expect more rate cuts. We're pretty much at the end of what we're going to do. But later that week, we got Q1 GDP for Canada. Not Q1, sorry, August GDP, negative 0.3. So maybe the governor spoke too soon. Let's see what the Fed gave us. 25 basis point cut, we were all expecting that. End of QT, we were all expecting that. It was just a matter of when. December 1st, I don't know why you wouldn't do it November 1st. Maybe they felt, well, it's October 29th, November 1st is too soon. Okay, December 1st. $5 billion of U.S. Treasuries was running off. That'll be canceled. $35 billion of MBS was running off. That'll be canceled. Well, I shouldn't say canceled. This will still be allowed to run off, and the proceeds will then go into more Treasuries. Only about $15 billion of this 35 was actually maturing each month because prepayments are really, really low. The Fed funds rate would have to drop a lot for prepayments to increase, for the speed of these to increase. And based on what Powell said, I don't know if we can expect that by May. The market seemed to think, oh, well, that's it, and started pricing out rate cuts well past May. And we know that May is the passing of the guard. I don't know why there wasn't a kink in the Fed funds futures curve, but it all came down. This amounts to 240 to 300 billion incremental demand for treasuries over the next, starting from December over the next 12 months. Somewhere around 300 billion by the end of next year. you have an incremental buyer, a price-insensitive buyer in the market. Now, he did say he wanted to shorten the duration of the Fed's balance sheet. But those MBS will have very, very long duration. The market took it to mean that, well, he's just going to buy T-bills. Nothing but T-bills. I'm uncertain as to the validity of that unless I hear the words coming right out of their mouth that, yes, we are in fact just going to buy 1 month, 3 month, 6 month securities. At high interest rates, the speed of these MBS drops significantly, such that their duration in normal times, with normal PSA, their duration would be equal to about a 10-year Treasury. But at higher rates, the duration of these things start increasing towards 12, 13, 14, 15, 16. So it would probably be closer to a 30-year bond, meaning its duration, its sensitivity would be somewhere around 16 or 17. So as the MBS runs off and they invest in treasuries, even go into a 10-year treasury, they do, in fact, probably cut the duration of that money in half by just doing that. So when he said he wanted to lower the duration, I didn't take it to mean that they were going to pile up all in T-bills, but that the money coming out of the MBS would on its own lower the duration. Unless, of course, they want to get that duration down faster, which means the maturing U.S. Treasuries would go into shorter duration, but that could be done with the 2-year, the 3-year, the 5-year. This is the big one. ZQ was holding tight, and then suddenly ZQ just dropped off a cliff. And the words he spoke at the time to cause this were this: the December rate cut is not a foregone conclusion. Far from it. Boom. This is what did it. Far from it. You had 2 dissents. Mirren said, no, it's got to be 50. Otherwise, I'm not playing. And Schmidt said, no, you got to do nothing. Otherwise, I'm not playing. I don't know that was a wise thing to stick your head out like that. But there it is. Powell mentioned ex-tariff. Ex-tariff. PCE is running about 2.4%, not far from his target. Why the hell was he so hawkish? Clearly, he can see that the labor market is flat. Well, we're not shedding jobs, we're certainly not adding jobs. The labor market is flat. And he's admitting that PCE ex-tariffs is really not that far from our target. But because we're not getting any economic data, we're in a fog, it's best just to stand still, because inflation might be higher. Without saying, well, what if labor is lower? What if labor is printing a negative? I don't think he feels that a drop in rates is going to help the labor market. Jobs are not be non-existent for 5 months. You can say 6 months if we believe ADP's last number of negative 32. We're getting ADP this week. On Wednesday, we get another ADP. Job cuts announced last week. Amazon, Target. Well, Target was the week before. GM, Paramount, UPS. GM is 3,300 with, I think, 1,700 of them being permanent. And the others just expected to be recalled by the end of the year. Besant was on Fox later that day talking about the next Fed chair, saying round 2 of interviews will be held in early December and a list will be submitted to the president by Christmas. I think I can tell you who will be on that list. And then he went on to say the Fed is stuck in the past. They're going to find a leader who will revamp the Fed process. He said that, but also there was a lot of bullshit and bluster that came out of his mouth. He is sounding more and more like Trump every day. I am a soybean farmer. Maybe you don't know this, but I am a soybean farmer. No, he's not. He happens to own land that he's renting out to a soybean farmer. So he's a landlord. He's not a soybean farmer, but, a little bit of bullshit here and there never hurt, right? You always learn from your mentors, and he's decided to adopt Trump as his mentor. Talked about tips. I'm also the head of the IRS, and I'm seeing that the withholdings have not changed from the service industry. I don't know how he's getting that granular detail, but okay, the withholdings have not changed. So the Americans are going to get refunds. They'll just start to change the withholdings in January, and Americans will get whoa, 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 whoa. What's this, Americans? You mean people in the service industry only, right? Only in the service industry. Well, but it's okay. People, aren't going to really pay attention to the bluster and the bullshit, but you're getting a lot of that out of Besant now. In fact, almost everyone who talks, you're getting that Trumpian flavor of saying things. Let's just say things that we want you to believe are true. And if the data don't support it, we'll fire the people who present you the data because obviously it's rigged, right? The deep state has a Trump derangement syndrome. Look at this repo. The repo facility from the Fed. Look at this big jump. Now it is month end, and for liquidity purposes, things are moved around. I have securities on my balance sheet. I want to look more liquid than what I really am. I'll repo them. I'll get cash on my balance sheet. There, I'm a little bit more liquid. Then the next day, I'll just give that cash back and get the securities back. So it's hard to pull that apart. We have to see what it looks like going forward. But this is the highest since June of 2020. Over 50 billion of securities presented to the Fed. Now this is very curious. I'll explain that when we get to the reverse repo, because the reverse repo has a balance. Let's have a look at the effect on rates and yields. Rates had already priced in the cut, so there wasn't really much of a move. We see the 3-month at 3.89, 4-month at 3.87. You got a 3.79 at 3.7, implying that there's probably within 6 months or a year one more rate cut. Effective federal funds rate is 3.87. 3.87. So the 3-month is saying, we probably don't see anything in the next 3 months. How's that sound? And the muscle memory of the market, we got a rate cut. That means I want higher yields on treasuries because inflation. Meanwhile, it was a very hawkish rate cut. You would have expected that the long end of the curve would have went, well, okay, he's concerned about inflation. Let's just hang out here. But no. Up it went. Can you hear my frustration? TLT has just disappointed me for too long now. 92 it was at, and I was thinking maybe now we break 92. And then, nope. Ran all the way to the 90 level, and I'm hoping 90 is the new support. If it breaks under 90, well, I think going into the end of the year, I know where I'm going to be tax loss harvesting is in TLT, but I'm not going to get out of duration. I'll just move into treasuries with the same duration. I'll get a 100 basis point higher yield for doing that, but I lose the options. But, well, I guess I could still play the options on TLT. But I've just been disappointed for too long. And maybe I'll do that. Unless we get, some respect on the long end of the curve. December. 91% was the probability. The implied probability based on where Fed funds futures were as to a 25 basis point cut. Out to 63 now. And 37 on the zero, and we know what the market is like. They will begin to talk themselves out of a rate cut more and more and more and more as each day goes by. That narrative will build on the day before to the point where you say, how are we ever going to get a rate cut ever again? So I would look probably for this to head towards the 50% and maybe even below the 50% as we move through November. The longer the shutdown lasts. I think it's going to end soon. Trump likes records. Trump likes his name on records, good or bad records. It doesn't really matter. The shutdown is approaching a record. As of November 5th, it will be 36 days. That's a record. Okay, it's time to settle this out. Maybe bring it to 40 days for good measure, but it'll be time to settle this. So you might get something soon. in terms of the government going back to work and getting data. I think for this to get back to 100%, because the market will run with the same narrative, and even though it repeats the same thing every day, the market will get more and more convinced, because now we're hearing it again on a second day. It must really mean something, and a third day it must really mean something. The Fed is going to have very clear evidence that inflation is not a problem, that it is in fact coming down, and that the labor market is maybe printing negative numbers. But until the government reopens, we're not going to get that. I'm going with 0% in December based on this Fed, and based on, I would say, the data dependence, the backwards lookingness of this Fed without the ability to look forward. A Fed that has a horrible record of forecasting anything. A horrible record of forecasting anything. What a shame. ISM, we still have that. That is private. We get manufacturing PMIs on Monday, and we get services on Wednesday. So we do get some data. ADP, also private, we're going to get on Wednesday. ADP, I didn't think there'd come a day where I'd say, okay, ADP is going to matter. It's the always wrong ADP, but now it's the only thing we got, ADP. Treasury refunding estimate we get Monday night, and we get the Treasury refunding announcement Wednesday at 8:30. So 8:15 and then 8:30, both risk events for duration. ISM manufacturing, well, it's been weak for a while, but we're bringing manufacturing jobs back to America. It would be embarrassing if the ISM manufacturing showed declines in manufacturing again, declines in employment. That would be embarrassing for the administration, wouldn't it? But from what I understand, the statement is already prepared that if this number shows contraction in the manufacturing sector, it's because most of the people who are doing this are left-leaning liberal lunatics. And then services we get Wednesday. Challenger job cuts we get on Thursday. So we do get some data, and we got a lot of Fed speak this week. I don't know that it really matters. It should not matter. Whatever they say should not matter. Because you're going to have a new chair announced before the end of this year, and it will be someone who will do Trump's bidding. You got a second round of interviews, and the interviews are going to go along the lines of, where does your loyalty lie? Do you agree with President Trump? How do you see yourself getting this done? What do you need from us to get this done? Is it possible to get this done? And they will put somebody in place who will get this done. My leaning is Rick Reeder, because he's a market guy. He'll understand the trade. He'll understand the trade. He's a market guy. Or it'll be Bessent, because Bessent has shown himself willing to do the president's bidding and to speak with the president's voice and to engage now in open bullshit, much like the president does. So we'll see if I'm right. It'll be Rick Reeder or Bessent. Maybe Reeder will be put in charge of the Treasury and Bessent will go to the Fed. Maybe Bessent will stay with the Treasury. Reeder will be at the Fed. But it will be, second round of interviews is going to be the loyalty interview. You know, do you agree with Trump? How are you going to get this done? So that's the only thing that matters. Canada, we get jobs on Friday. Let's see what those look like. Look at reverse repo. 51 billion, 51.8 billion. The repo, 50 billion. Why couldn't they get together? So what's going on here is these people have agreed to accept 3.75% on their money overnight, and these people over here have agreed to pay 4% on their money overnight. You're getting 3.75, they're paying 4. Why don't you just take the 4? This is saying that even at 4, these guys were saying, nah, we'd rather get 3.75 safely than to get 4 with you guys. Even though it's secured, it seems odd that they wouldn't just get together, that it wouldn't clear in the repo market, but it didn't. TGA sitting at 983 billion. TGA is not part of reserves, but you're not paying anyone. So obviously, as this builds, reserves will drain. Look at this, you're at a 2.8 trillion on reserves. And that is going to add stress in markets simply because you are getting past the point or close to the point of ample reserves, maybe less than ample. But as the Treasury builds, the reserves will drop because Treasuries aren't part of reserves, or sorry, the TGA is not part of reserves, and unless the TGA actually gives it to employees who then put it in their bank account, once it's deposited in their bank account, now it's reserves. So once the shutdown is over and all those back payments have to happen, this is going to drop dramatically. This is going to spike. Let's look at our slope. Look at that, 22 on the 3-month to the 10-year. The 3-month really didn't move much because it had already priced things in, but the 10-year went up 9 basis points. So now you have a upward slope from the 3-month to the 10-year. The 2 to the 10 really didn't change that much. Last week was 54, it's 51. You actually had a bit of a flattener week over week. Now look at the Fed funds futures. Powell has gone over here. He's in the game up to May. So my thinking is this dot should have been higher. It should have been rational up to here and then irrational, representing Trump's desire, not a rational committee of 19 people. Well, there aren't 19 people voting. There are 12 people voting, but it shouldn't have been a rational consideration. It would be, the market should be pricing in a new Fed. Trump campaigned on tariffs, and the market said, okay. And voters said, okay. Because everyone thought, well, there'll be tariffs, but they'll be done in a rational way, right? And it was a shit show. And it still is a shit show. You get tariffs, you don't get tariffs. You shook my hand and smiled, you get 10% less. You wrote an article I don't like, you get 10% more. I don't like your TV ad, there's 10% for you, the Mad King. And here's Trump saying, rates have got to come down, rates have got to come down. There'll be a new chair of the Fed, too late, Powell's got to go. And the market's going, okay. I guarantee you, it's going to be a shit show. It's going to be a shit show. It's going to happen fast. It's going to be very quick. I don't know why the market is saying, well, we saw what Trump did with tariffs, but he won't do that with the Fed, will he? He's not going to put somebody like a lackey in charge of the Fed, is he? Like he did with other departments who are loyal to him. He's not going to do that. Yes, he is. Yes, he is. So why it's not doing that steepening at the end, I don't understand, but I'm all in. Effective federal funds rate at 3.87. Q4 is 15 points. There's your 60%, right? 15 out of the 25. Q1 is saying, another 16 basis points. Q2, 18. It's like 60, 2/3 bet on a cut on each quarter. Q3 is looking like the market wants to say a full cut. So you're getting 71. That is 3 in 7 by the end of Q3. That is the October ZQ, right? 9.84 implying an internal rate of 3.16 or an implied rate of 3.16. We're at 3.87. There's your 71 basis points. 3 cuts in 7 meetings, and 3 of those meetings will be without Powell. And Bessent is saying we will appoint someone that will revamp the Fed. They're too backwards looking. And look at what he did with tariffs, and we think that, oh, no. The Fed is going to be, whatever Powell says now is, that's it for the next year. Powell's dead. Powell's gone. There'll be a new voice at the end of this month that will override anything Powell says. So I'm not sure what's going on here. December is 96.92, pricing in 3.08. That's 2 more meetings. October. I should circle the September. It would be the October meeting and I believe an early December meeting for the December. So you're going from 3.16. It's 8 basis points difference for 2 more meetings at the end of the year. I don't think so. I think he's going to look at Canada at 2.25. He's looking at Europe. He's saying, why are we at almost 4% here? 3.87. We should be at 2%. Get it down there. 2 to 2.25, which means the ZQ. I think he'll front load that. I think it'll happen well before October. Should be 98 to 97, probably 80. Halfway through, call it 87, 97, 87 to 98, a full 100 basis points more than where we are now. Now, I don't know if anyone is paying attention after 5 o'clock. The activity that went on in ZQ moved 3 basis points. That's a big move in that last hour after the market closes. You get to Friday at 4 o'clock, then ZQ just started going up. Over the next hour, 3 basis points. Again, 3 doesn't sound like a lot, but if you watch it, ZQ during the day, a 3 basis point move's a pretty big move. It moves half a basis point, maybe 1.5. Big moves like 8 or 9 happen around risk events, but 3 in the last hour on a Friday across the curve. I found that very interesting with a question mark. Overall, I think the market is absolutely wrong on this one. I think we should start to see something like this going on. After May, it should be a distinctly different curve. Be rational till May, okay. But after May, you really have to start pricing in a Trump Fed funds futures curve and not a Powell Fed funds futures curve. Real yields, all higher, and not much change on inflation expectations, just higher real yields as a result of this. And OAS, again, just nothing to see here. This is 285 on the high yield index. Triple C sitting at 8.22. I think it's been as low as 7.5, 7.4. The mortgage rate, 6.17, creeping, fighting slowly its way to printing a 5 handle on this one. Psychologically, that will mean a lot, having a 5 on the handle as opposed to a 6. Mortgage apps for October 24th were up 7.1%. Still, this is an industry, a whole sector that has been in recession for a very long time. Another Jamie Dimon cucaracha, a cockroach. BlackRock's private credit arm, HPS, has uncovered breathtaking fraud in some of the loans that they made to broadband, telecom, and bridge voice. Bankum Brambat, Bankum. It's a great name for somebody who's committing fraud, eh? Bankum Brambat is the owner. Fabricating accounts receivables, about $500 million worth. Fake customer emails mimicking real telecom companies. They were just made up. They were just fake emails. So when they went out to the offices to confront the person, the offices are empty. There's no one there. And somebody in the building said, I haven't seen anybody there. Went to his house. Nobody at his house. Wednesday, October 29th, offices locked and vacant. These companies, they sold services and infrastructure to telecoms. Pure fabrication. Who's doing due diligence on this? I mean, who is doing due diligence on this? You have to ask the question that if it's this easy to get these guys, BlackRock, BNP, that you can pull the wool over their eyes for that much money, if it's that easy, I'm in the wrong business. Although I don't have it in me to do that. $500 million, probably a lot of people are looking at that going, really? That's all you had to do is fake emails. Now, the emails probably went somewhere where he answered them saying, oh, yes, I can verify that they're a customer, and it probably looked official and everything without looking at the fakeness of the email. How many more cockroaches are there? Now, this would be more terrifying if you have these people who gave money to these people, this is wrong, these people lose. Great. But if you had derivatives on top of derivatives on top of derivatives on here that made this 500 million suddenly 4 billion because of all of the derivatives on here, and then you had another layer of derivatives on top of these derivatives, then yeah, that becomes a big problem. That was the housing market. Wasn't so much the mortgages themselves, lots of fraud going on there. It was the pile of derivatives on top of that that took everything down. I said last week that I don't know how big the derivatives market would be on this, if there is even a derivatives market. If there is no derivatives market on all this private debt, then it's really just the investors that are going to lose their money. There's no cascade effect from derivative to derivative to derivative. Okay, nice article in the Wall Street Journal this week. Big tech is spending more than ever on AI, and it's still not enough. Meta, Alphabet, Microsoft, Amazon increase spending in 2026. Are we in a bubble? That question just keeps getting asked. Yes, we are. No, we're not. Yes, we are. No, we're not. Oh, that's different this time. Beware those words, right? This chart came with it. This is the market value as a share of the S&P from 2015. These companies made up less than 10%. They're pushing 40% now. The same 7 companies. They add up to 37.5%. 7 companies. Out of the 502, 503 in the S&P 500, 7 of them are almost 40%. So the other 495, 496 make up the other 62.5. Wild. Meta says it's still running up against capacity constraints as it tries to train new AI models and power its existing products at the same time. Microsoft says it's seeing so much customer demand for its data center driven services that it plans to double its data center footprint in the next 2 years. Amazon said it is racing to bring more cloud capacity online as soon as it can. We've been short on computing power now for many quarters. Not that we're going to catch up, we are not. Demand is increasing, said Amy Hood, Microsoft's chief financial officer. When you see these kinds of demand signals and we know we're behind, we do need to spend. Let's look at monthly active users. Gemini in March of 25 had 350 million. July they reported 450. On their last earnings they reported 650, 350, 450, 650. Look at that. This is a monthly going to daily 75 million active users per day. ChatGPT estimate somewhere in there is 800 to 900 million active monthly users, 190 million daily, still more than double the size of Gemini. Claude, really low, monthly active users, 40 million. That is like 1/20th of what ChatGPT is. Meta, about 1 billion. However, it's primarily through their integrated features for Facebook, Instagram, and WhatsApp versus some standalone app. So Gemini, ChatGPT, Claude, you have standalone apps. Meta is reporting 1 billion, but through these integrated features. So there is a lot of spending going on. And the conversation is about all the related deals that are happening. I took the opportunity to dive into 2 of these types of deals. Oh boy, are they brilliant. They're simple but brilliant, and because we're dealing mostly with a retail crowd, they're not going to get it. I'm going to look at MP Materials, the deal with the Department of Defense, and I'm going to show you how that deal works and what it looks like and how the cash flows through, and it is very shocking. And when we look at OpenAI and AMD, we find the same footprint. Let's look at SPY, another all-time high on October 29th, 687.39. Market finished Friday 0.77% below that. Same with Triple Q, October 29th, another all-time high, and it is now 1% below that. I think we can look at Meta as a big cause of that. October 15th, still IWM 250.33, got close, I ended at 246.23, down 1.64%, and IJR still hasn't taken out its. IV is increased on S&P. 13-week percentile is now the 85th percentile, up from the 55th percentile. Forward 4-quarter operating earnings 294, closing SPX 68.40, pushing well into the 23 times forward operating earnings territory, 23.2 times versus 23.04. Getting very comfortable with the 23, and the narrative is shifting that if 40% of the index are the Mag 7, obviously you'd expect to see a much higher multiple, probably closer to 25 or 26. So at 23, aren't we undervalued by a good 600 points? And if we are undervalued by 600 points, shouldn't the ending SPX on the index be somewhere between 7,000, let's say, and 7,400? Take a midpoint, 7,200. Has anyone got a price target? 7,200, is that on anybody's bingo card? Because there we are. IV last 14.2, and we have another big week of earnings coming up. We had our Fed meeting last week. We don't have anything really big this week. We've got ISM and we got ADP, and we have earnings. And for this earnings season, I'm seeing that when companies are rewarded, they're rewarded a little bit. But when they're not rewarded, when they're punished, my God, are they punished? 136 companies, 135 companies. It depends on what you're looking at. I don't know that we'll ever get that right. But let's take a walk through the list of companies that are reporting. We did, if you're on the Discord channel, if you have the applied level, you know that I did some earnings last week. The only one that really got me into trouble, or trouble that I got to try to figure out what it's going to look like, is Meta. It fell a lot more than I expected. I am now long Meta. I allowed them to be assigned to me, but I married them off with a 650 call that gets me out nicely. And we'll see what happens, but the earnings vol plays have been working out quite well. Okay, we'll use selectspider.com. I like this one because I can just categorize them in the sectors that they're reporting. So I could just go to I can ignore the sectors I don't like. For instance, XLV, healthcare, I don't like anything in there because I don't understand it, so I don't play it. Real estate usually offers you very little opportunity. They don't have very good options. XLE, usually not very good options either. XLK is the best one. XLU, same thing. The options aren't very good. Not a lot of IV gets priced in to the options before reporting. Consumer discretionary does very well, and XLK and communications do very well. On semi is the only interesting one, but I believe they're before the market opens, and you would have had to set this up Friday. The expectations for 59. Last year at this time they did 99, so like a 40% drop in EPS going into Tuesday. XLB, XLC, we have Match Group, XLE, you have a couple in the energy sector, still some in the financials. Your industrials, Stanley Black & Decker, Uber, Palantir, here's your technology, Palantir, AMD. AMD is going to be interesting. I'm going to talk about AMD when we talk about MP Materials, about the deal with OpenAI. I do have some details on what that deal does look like, but we're going to get a lot more detail when AMD reports. Supermicro, Gartner, CDW, and we got some in the staples. They have not been doing well at all, staples. Some in real estate, some in utilities. These are very highly dependent on the shape of the yield curve itself. Healthcare, which I don't really pay attention to. And then we got Yum Brands, Norwegian Cruise Lines, and Marriott. What do we got for Wednesday? Let's see, Live Nation in communications. We have some energy and financials going on. XLI industrials, nothing I really play with. XLK, AppLovin. Let's see what they do. They've been bouncing around like 550 to 650. Talk about high IV. They've been bouncing around there for quite some time. Let's see what they say on their call, because there is some accusations being thrown out at the company that they're doing something bad. Qualcomm is in there. Let's see what their guidance is going to be after their deal announcement. We have some in real estate. We have some utilities here, but these are not utilities I play with. I don't play in healthcare. And DoorDash and McDonald's we have on Wednesday. On Thursday, CF Industries, they were hitting 52-week highs earlier this year. They've pulled back from that and have not since breached those levels. DuPont Communications, Trade Desk, and you got Warner Brothers in here. You have some energy, ConocoPhillips, Robinhood in financials, XLI for your industrials. Nothing I really pay attention to here either. XLK, Fortinet, they didn't do well last time. Dropped below $80, down to 78, 77. I think maybe even down to 75. They did not do well last time, but Cloudflare reported last week and did really well. And we'll have Palantir earlier in the week. We'll see how Fortinet does for cybersecurity. Hey, Fair Isaac. Let's see, we have one in staples, one in real estate. A bunch of utilities are reporting. More in healthcare if you're into that, and in discretionary, Airbnb, Wynn Resorts. And on Friday, everything on Friday is usually the morning. Take Two, News Corp, financials. You have Block. Let's see how they do based on how Fiserv did. Fiserv not good at all. I believe Block is an alternative competitor to Fiserv. Fiserv is the incumbent. Block is the disruptor. XLK, nothing I pay attention to here. Monster Beverage and XLP. XLU, you have Duke. There's half of Florida there. Constellation Energy. And Expedia. There's our earnings for the week. I don't know that I'll be playing too many of these. There might be half a dozen to a dozen that look interesting out of the 130 that we have. Before I start discussing MP Materials, if you wanted to get up to speed on rare earth metals mining in the materials sector and sector studies, you'll see Understanding Gold Mining. These are videos over here. Here's a PDF on understanding rare earth metals mining, and it is just a very short primer. It's not very long at all, but it'll bring you up to speed on heavy earth and light earth mining. So that you might have more of the language as you're going through MP Materials and any of the other U.S. rare earth mining companies. Okay, this week I'm going to highlight MP Materials. I was going to do this one anyways, but as I started digging into the deal, it's a little bit confusing at first. So you get a sheet of paper out and you start mapping out where the cash is flowing from. And then it all came into perspective. And I thought, this is a brilliant deal for Department of Defense. It's also a brilliant deal for MP Materials. I don't know too much about the shareholder, but whenever you have a great deal, somebody somewhere has to pay for it. It's the shareholder that's paying for this one. I'll show you where. And I thought, I wonder if this is the same for all the other deals. So I went to AMD to see what I could find out with their deal with OpenAI, and it was shocking because it fits the pattern. So I'm going to tell you what kind of deals these guys are doing. But first, let's get some background. Let's understand what the company is doing, and then we'll look at the deal. And it is worth spending time with the deal, so we will do a walkthrough of the PDF of the 10Q from MP Materials where they describe the deal. This is a single site mine. This is the Mountain Pass in California. With most mining companies, you have multiple sites so that you don't have this high risk exposure from one site being down for a while. If one site goes down, this whole company goes down. The company is based in Las Vegas, Nevada. operations in California, mining operations in California, and manufacturing operations in Texas. As of December 31st, 2024, their 2P reserves proved and probable 2.04 million tons of REO, rare earth oxide. And it is the light variety, not the heavy variety, and that is embedded in almost 30 million tons of ore. It gives them an average grade of about 5.97. To determine their 2P reserves, they used a cutoff of 2.5%. Anything below 2.5% is not commercially viable. And maybe not even technically viable. So anything above that goes in their 2P reserves. That gives them a life of mine of 29 years. That's it. This is a 29-year asset. So whatever it produces during that period of time. Now, over time, prices of rare earths could rise dramatically such that your cutoff might be 2%. Or technology might improve significantly, and recovery rates and refining might improve significantly, such a cutoff is 1.5%. So this life of mine could extend depending on the evolution of prices and technology. But as of right now, it's a 29-year asset. Huge volatility, 76% implied volatility. A 1-week straddle is 9.5% of the price. A 1-week straddle, not a 1 month, a 1-week straddle is almost 10% of the price. Crazy, isn't it? Department of Defense, $400 million for a preferred equity stake. This preferred equity stake is convertible. It is cumulative. It's a PIK coupon, which means paid in kind, which means they'll get more and more and more preferred shares that are all convertible. The conversion price is about $30.07. They also got warrants for 11.2 million shares. Conversion at 30.03. So if right now, based on the conversion price, they are all convertible. So you have to assume an as converted basis. So when you're looking at EPS, they'll be basic and diluted. The diluted will convert all of these. They would have 15% ownership of this company. They do not have ownership right now, but they would have 15% ownership. My guess is they will never have ownership. Now, as the preferred shares, it's 7%. So after the first year, they'll have actually it's quarterly. So they'll actually have more than 428 million. It compounds quarterly. They'll actually have more than 428 million shares of this. And then it's 7% compounded quarterly the next year, the next year, the next year. No matter what, they cannot exceed 19.9%. So they'll be anywhere between 15 and 19.9% on the conversion. They cannot own more than 19.9. That does not mean they can't convert more than 19.9. They just can't own more than that. They can convert and sell. There is a benchmark price that we can look at because there is a floor price that they're offering for a particular product. And if there's a floor price, there has to be some swap contract in place. And that swap contract would have to point out a benchmark price. Benchmark Mineral Intelligence publishes, and they just started with this, a benchmark quarterly average volume weighted price. So it's not a quality benchmark. Like WTI is a location and quality benchmark. It specifies the grade of oil and the location. And then everything is a discount from that, depending on the quality of the oil you're delivering, and the location could be a discount or a premium to the benchmark. This benchmark is just, well, what's the average weighted price of everybody selling everything? So it's really just an average for NdPr metal and oxide. The last reading for the benchmark was $65,915 per metric ton. If you divide by 1,000, because that's kilograms, it gives you $65.92 per kilogram. We will see later that their realized price in Q2 was $57 per kilogram. A little math gets us there, and they're being offered $110 per kilogram. And this is going to be done as a swap. So if the price is below the 110, the DOD will top them up to 110. If the price is above 110, well, then that goes back to the DOD, so that they'll always have the 110. Let's look at what they're getting done. their stage 1 to 3 strategy, their big goal is mine to magnet. They're not going to sell their concentrate. Part of the deal with the DoD is they had to stop selling their concentrate to China, which was all of their revenue. And they stopped in mid-April. So they haven't been selling any concentrate. They've just been stockpiling it. The payments from the DoD only start on the first day of the fourth quarter. So their third quarter, which they report Thursday we get their report. Third quarter, I don't know where their revenue is going to come from because it's not coming from concentrate. So it's going to be ugly in terms of revenue, but guidance is going to be everything on this one. So they want to go mine to magnet. And there are 3 stages in getting that done. Stage 1 is concentrate production. In other words, you take the ore out of the ground, which has a grade of 5.97, and you get rid of as much garbage as you possibly can to get the grade as high as you can. You leave the good stuff, get rid of the bad stuff. That is called concentrating. You're concentrating the amount of the stuff you want in what you still need to process. That's called concentrate. They've been doing that for a while, and their revenue comes from they get their concentrate, and then they sell their concentrate to refiners and production facilities. Well, mostly to refiners, and then refiners will sell to production facilities. But now they don't do that. Let's look at Q2. This should say 25. Sorry, Q2 2025 versus Q2 2024. Revenue for the quarter was 57 million. If you are in the mining sector and you pay attention to mines, 57 million is a rounding error for most mining companies that they usually are reporting in the billions. So you see this is a very small mining company. Last year was 31 million. The cost of revenues, 50 million. This is just the cost of these revenues. That's all it is. It's not all of your costs. This is total operating costs, 101 million on 57. And 84 million on 31 of revenue. So you can see that they have negative operating earnings. For EBITDA, because this is something we're going to have to pay attention to. Let's look at first 6 months EBITDA, because I want you to really pay attention to the math when we adjust for the 110. If we go back and we adjust that price and say, well, what if they did get 110? What would it be? And you'll understand why the 110 when we see the number. First 6 months EBITDA, negative 36 million. Here was negative 48 million. So they are moving in the right direction. The higher the price of the stuff you're selling and the more that you can get out, the better your efficiency, the higher your profitability. And that efficiency usually comes with scale in a mining operation. Stage 2. Actually, with stage 1, they do say this. They're running 40,000 metric tons per year. The target is 60,000 metric tons of rare earth oxide. So they want to increase their production in stage 1 by 50%. That will go a long way to bring them out of the negative EBITDA that they're at towards zero, maybe even positive. Stage 2 is separation and refining. When you concentrate all this stuff, you'll have a bag of concentrate, which is usually what you'll have, and it'll all be this little fine powdery stuff. Well, all the minerals are in here together. You have to find a way to separate all these minerals, and that is what separation is doing. That is stage 2. It is operational and ramping up. And the expectation from their own 10Q, expect that it may take many quarters to achieve the designed output of REE. We're going from REO to REE, rare earth oxide to rare earth elements. To get separate them out of the oxide, you end up with elements. It may take many quarters to achieve the designed output of REE. They expect unstable operations and elevated costs. That is stage 2. Stage 3, the stuff out of stage 2 goes to stage 3. So stage 1 output goes to stage 2. Stage 2 output goes to stage 3. Magnet manufacturing is in progress. 2 facilities on this one. This is the most complex stage. Their Independence facility should be producing magnets. not just precursor, but magnets by the end of 2025. And then they're building a new facility called a 10X facility. I can only imagine 10X means 10 times the output. Because I looked around and say, why the name 10X? And it wasn't jumping out at me. I wasn't going to take 10 hours to figure out why you're calling it 10X. I just know Wall Street's likeness for simple names, and we'll see. It was Goldman and JP Morgan put this deal together. It was probably just called a 10X facility because it was 10 times the size of Independence. So they used to do stage 1, and that was revenue. Now stage 1 will go to stage 2 with a floor price. Stage 2 will go to stage 3. Stage 3 will get output. The DoD has agreed to buy 100% of the output. But before you get too excited, there is no floor price for the output. The more efficient the company becomes, the better it gets at manufacturing magnets. The cost of producing those magnets goes down. That's what the DoD pays, its costs. Period. It pays its costs. Cost for it. So even though it's providing some support over here, it takes it away over here by saying, well, we're not going to pay a markup over there when we paid a markup over here. We'll give you the markup over here so that your mine is profitable, so you don't have to worry about China putting you out of business by dumping oxide or elements on the market. But over here, we're only going to pay your cost. However, we will guarantee you a certain amount of EBITDA. Wait till you see who pays for that EBITDA and the brilliance of this setup. It's incredible. Let's move on. Okay, so to understand what we're going to be reading a little later on, let's look at the two segments that MP operates in. Materials and magnets. Materials incorporates the upstream and midstream part of the business, and magnets are downstream. Part of the DoD agreement was MP Materials had to cease all sales of concentrate to China. They did this around mid-April, and they agreed to stockpile it until they needed it. The floor price, which we'll see over here, of $110 per kilogram begins the first day of Q4. So Q3 will have no revenue, at least from sales of concentrate to China, and that was primarily its revenue. The revenue was sales of RE concentrate, primarily neodymium, praseodymium. I'll say that fast, right? NdPr, the oxide and the metal. The upstream, midstream are at Mountain Pass in California. There is a fully integrated mining and refining facility. So you get that far, but no production. That is where magnets step in. This is downstream. In Texas, they have a facility called the Independence Facility, metal alloy and magnet manufacturing plant. July 10th, the DoD deal. They are expected to expand Independence and construct a second facility called the 10X facility. Also, they have to expand and accelerate heavy rare earth element refining capacity at Mountain Pass. Remember, when we talked about their reserves, it is mostly light, not heavy. The big parts of the deal, this is not mentioned, with caveats, with provisions, with caveats. Floor price of $110 per kilogram of NdPr oxide. This begins the first day. So this started October 1st. And this is usually done in a swap. So you'll have a swap, you're swapping one price for another, and those, we'll just draw out the 110. And you'll need some benchmark price to price out whatever cash rate you're getting. So if there's a certain cash rate, they're offering 110. This is the benchmark price. They will pay the difference for whatever this benchmark is. So if this benchmark exceeds 110, the company would then have to pay the DoD the difference, so that you're always just getting 110. Floor price of 110 per kilogram. 100% of the 10X output for 10 years after it ramps up to full production. It could take 5 years to ramp up to full production. Remember, life of mine is 29 years, right? You got to build this facility, and then you have to ramp it up to full production. Once at full production, the DoD says, we will buy 100% of your output. There are provisions here about buying this output. And we will guarantee $140 million of EBITDA beginning in 2026. 10x only. Remember, you have stage 1 and stage 2. You have your upstream and your midstream. You're on your own over there. However, this floor price over here will help you out over here. How's that sound? And we will buy 100% of your output over here over 10 years, but we're only going to pay cost. We're not going to pay any kind of profit whatsoever. But we will do this instead. We will give you a payment for whatever shortfall you have from EBITDA. And it kind of works like this over here. There's your 140 million of EBITDA. We will buy 100% of your output unless you want to sell it to someone else. If you can sell it to someone else, go ahead, and let's say you produce 170 of EBITDA. Well, you owe us that 30. You got to give us that 30. Thank you very much. So there's no point in you going to sell it for 170 because in the end you'll end up with 140, which is what we're going to give you, so you may as well sell it to us at cost. Only if they can exceed 170. Let's say they get to 190. Well, the first 30 goes right to the DoD, and then it's a 50-50 split after that. We don't hear about that, right? Wait till you see where they come up with the money. Like, let's say that EBITDA was here. Well, the DoD would step in and pay this. Wait till you see where they come up with the money for that. Let's read the agreement first before we look at an idea of how can you possibly value something like this. Okay, I'm on there, Q2, 10Q for second quarter. The deal with the DoD is on the SEC website, by the way, but it is the legal contract, and it's thick. So unless you know how to read legalese, it's going to seem confusing. If we're off, they're off, you go this way, not forgiving this on this day of this day if you're wearing pink. Yeah, I mean, it just goes on and on with this stupid legalese stuff. It's easier just to read it here. Let's just read a bit of it so that we understand what's going on. Business overview. MP Materials, including its subsidiaries, largest producer of rare earth metals in the Western Hemisphere. We own and operate the Mountain Pass Rare Earth Mine and Processing Facility, located near Mountain Pass, San Bernardino, California. The only rare earth mining and processing site of scale in North America. Also developing a rare earth metal, alloy, and magnet manufacturing facility in Fort Worth, Texas. That is the Independence facility. Reportable segments, primarily based on our internal organizational structure and types of products, are our two operating segments, materials and magnets. The DoD sits over here in magnets. The materials segment represents our upstream and midstream operations, primarily consists of Mountain Pass, a fully integrated mining and refining facility producing refined rare earth oxides and related products. The materials segment generates revenue primarily from sales of NdPr oxide and metal. Generates revenue primarily. Primarily sold to customers in Japan, South Korea, and broader Asia. Materials segment historically generated the majority of its revenue from sales of rare earth concentrate primarily to a single customer in China. April 2025, in response to China's retaliatory tariffs and export controls, we made the strategic decision to cease shipments of rare earth concentrate to China. July 25, to align with the terms of the DoD transaction agreement and in further support of our domestic supply chain objectives, we agreed to cease all future sales of products to China. Magnetic segment represents our downstream magnet manufacturing and related operations. Currently consists of the Independence facility, a fully integrated metal, alloy, and magnet manufacturing plant, where we produce and sell magnet precursor products and anticipate manufacturing neodymium iron boron permanent magnets by the end of 2025. I believe those are automotive. The magnetic segment began generating revenue from sales of magnetic precursor products to a single customer in the U.S. first quarter of 2025. That single customer is, drumroll please, GM. Certain rare earth elements serve as critical inputs for the rare earth magnets inside the electric motors and generators powering carbon-reducing technologies such as hybrid and electric vehicles, collectively known as XEVs. Wind turbines, drones, defense systems, robotics, many other high-growth advanced technologies. Our integrated operations combine low production costs. Well, we're going to put a question mark behind that. With high environmental standards, and we will put a question mark behind that. I think they're just saying this stuff, thereby restoring American leadership to a critical industry with a strong commitment to sustainability. You sometimes wonder who these things are written for. They did have a public offering of common stock. This is important to know because part of this deal, JP Morgan and Goldman Sachs had to guarantee at least $1 billion loan to the company, reduced by the amount of money that it could raise on its own. So they said, well, let's do that then. Let's announce this big deal and then let's do a stock offering. On July 18th, we completed an underwritten public offering with JP Morgan and Goldman Sachs as representatives of several underwriters relating to the issuance of 11.8 million shares of our common stock, par value of nothing, basically. At a price to the public of $55 per share, the underwriters purchased the shares of our common stock at a price of $53.35. So it was a bought deal. Not a best efforts, but a bought deal. Also guaranteed and it would be a bought deal because I'm the underwriter and I have to guarantee at least $1 billion loan. So you're going to issue shares and the proceeds from those shares will reduce the amount of my commitment. So why wouldn't I do a bought deal? Because no matter which way, I'm on the hook for $1 billion, so I may as well do a bought deal. So I did that. We also granted the underwriters 30-day option, which was exercised in full to purchase another 1.7 million shares of our common stock. So they sold 11.8 plus 1.7, raised $724 million from shareholders. So Goldman and Morgan are like, whew, okay, so that reduces us to $276 million that we would have to provide for a loan if they need it. 724 came from shareholders. We currently intend to use the net proceeds from the offering to fund the acceleration and expansion of our operations, including the 10X facility for strategic growth opportunities and general corporate purposes. They have an agreement with Apple. Let's just read this one. July 14th, entered into a definitive long-term supply agreement with Apple for the development, manufacture, and supply of magnets from our Independence facility. This is not the 10X. This is the Independence facility. The DoD is guaranteeing EBITDA for the 10X facility, not the Independence facility. So for that, as well as the development and installation of scaled recycling capabilities at Mountain Pass to produce the contained rare earths from post-industrial and post-consumer recycled rare earth feedstocks. In other words, all the batteries that come back to be recycled, you can reclaim the rare earth elements from there. In connection with the agreement and subject to achieving specified milestones, Apple agreed to make prepayments in the aggregate amount of $200 million for the purchase of magnets from us. So they'll get paid up front. Negative cash flow. A negative cash conversion cycle. Nothing to dislike about that. Execution risk is what Apple has at this point, and what MP Materials has. They have execution risk, but there's nothing from the shareholder here. They're not extracting anything from the shareholder to get this done. Apple is paying up front here. Maybe you need the money to get the stuff done. We'll pay you up front and you'll give us this stuff. From Apple's point of view, they're bringing some production back to America to please the Mad King. And they're securing a source of supply. Nothing wrong with that deal. This is the big one. The public-private partnership with U.S. Department of Defense. July 9th, we entered into a definitive agreement establishing a transformational public-private partnership with the United States Department of Defense to accelerate the build-out of an end-to-end U.S. rare earth magnet supply chain and reduce foreign dependency. As part of the transaction, we agreed to use reasonable best efforts. Look at those terms, reasonable best efforts, to build our planned 10X magnet manufacturing facility. That leaves risk on the table. That leaves execution risk on the table. It's a reasonable best efforts to build this thing. To produce sintered permanent magnet blocks. I'm just going to drop all the chemistry and geology here. You can read all of that, right? And or other finished magnets. Additionally, we agreed to use reasonable best efforts to, number one, expand heavy rare earth element refining capacity at Mountain Pass. Refining capacity. Because the mine itself is primarily light. You're going to have to buy heavy concentrate somewhere. Refining capacity. Unless, of course, there is some heavy element in what they have, but it's minimal. More than likely, they're going to buy concentrate from somewhere else. Which, after the DoD extends the samarium project loan, well, let's see how you pronounce this, right? Acetaminophen. Don't take Tylenol, people. It'll make it hard to pronounce words. As defined below to us, in accordance with the DoD transaction agreements, will include separation of samarium oxide. Also reasonable best efforts to recommission the chlor-alkali facilities at Mountain Pass. And 3, expand capacity at the Independence facility to a projected 3,000 metric tons of magnets annually. DoD is not agreeing to buy any of that output, by the way, but is saying, listen, you got to expand that facility. We have also agreed to use up to $600 million of our existing cash to fund these projects. So $600 million of their existing cash, they had a share buyback. We're going to see a little later that is now canceled. The money that would have gone to buy back shares will now be used to do this. Under the price floor protection agreement, the DoD will pay us a quarterly payment per kilogram of NdPr produced by us equal to the shortfall between 110 per kilogram and the benchmark quarterly average volume weighted price. If, after the 10X facility reaches full production capacity, the benchmark quarterly average volume weighted price for the prior quarter exceeds 110, the DoD will be entitled to receive 30% of the NdPr sales price, which exceeds 110 per kilogram. So there will have to be a payback to the DoD for that. The term of the PPA will commence on the first day of the fourth quarter of 2025 and will continue for 10 years and will apply to all of our products that contain NdPr. It's only 10 years and it starts October 1st, 2025, which means it ends September 30th, 2035. So if you're doing a valuation on this, you're saying, well, this is a 10-year swap and only a 10-year swap, but we don't know what the forward curve looks like for the price of this benchmark material. It could be that it goes way up. Well, the DoD will make some money on everything above the benchmark price. But for 10 years, it has to pay the difference. Where's it going to get the money to get that done? Only Congress can authorize spending, which means this money is going to have to come from somewhere else. It cannot come from DoD spending. It's got to come from somewhere else. Wait till you see where it comes from. PPA provides that we will prioritize the supply of NdPr first to magnet manufacturing, with excess volumes remaining available for sale to commercial customers, subject to a prohibition on sales of certain restricted buyers and certain other obligations. So there is the weaponization for foreign policy of their product. Pursuant to the terms of the offtake agreement, the DoD agreed to purchase the entire quantity of magnets produced at the 10X facility. Notice, it's the 10X facility, not Independence. They're going to increase Independence to do 3,000 metric tons a year of output. DoD doesn't agree to buy any of that. Only the 10X facility. Provided, however, that up to 100% of magnet production may be syndicated to commercial and other customers under certain conditions. What is this saying? The DoD will buy all of our output if we can't sell it to somebody else. And the people we sell it to, the DoD would have to say, yeah, okay, it's okay to sell it to them. And you would think, well, then that gives them a whole bunch of upside. But the DoD gets that upside, right? where do we leave off? To commercial and other customers under certain conditions. The DoD offtake agreement has a term of 10 years following the commercial operation date as defined in the DoD offtake agreement of the 10X facility. So that does not start on the 1st. It starts on the date of commercial operation, whatever that date is defined in the offtake agreement. In accordance with the DoD offtake agreement, the 10X facility will generate at least $140 million of EBITDA on an annual basis after reaching full production capacity, adjusted annually in each calendar year, following 2025 for inflation at a rate equal to 2%. The DoD will also acquire magnets from us at a price equal to the production costs incurred in connection with the production of magnets in the 10X facility. So we have two streams of cash flow. We have cash flow number one, which is the difference between the benchmark price and 110 that would flow from the DoD to MP Materials. Unless, of course, it's over 110, then there is nothing to worry about, but it's nowhere near 110 right now. And with the China deal, I'm sure China will probably do the best it can to take other customers around the world away from the U.S. Because why would MP is not going to sell concentrate to anyone because they get 110 from the DoD. Why would they sell it to anyone? And even if they did sell it to anyone, they'd still get a payment from DoD, but why even bother? Right? Besides, their goal is mine to magnet. They can't sell the concentrate because they need to refine it, and then they need the output from the refinery to make the magnets. So I don't know that we're going to get over 110 for a while. So you have one cash flow going in to top off to 110. You have the second cash flow going in to top off to 140 million. Congress hasn't approved this spending, right? And the DoD is acquiring magnets at cost. No margin. You have a magnet that costs you sell them for, let's say, $20. It costs you $10 to produce. We'll give you $10. We're going to give you $10 for it. That's it. Whatever your cost to produce are. Sorry about that. This is a occupational hazard of having Apple devices around. When one goes off, they all go off. Let's keep going. I want you to keep that in mind, though. They're buying it at cost. And look at it just so far. Keep in mind where the cash flows are going to. The cash flows are going to the floor price, and the cash flows are going to the 140 million. We'll figure out where the cash comes from, but that's where it's going to. The DoD will make quarterly payments to us in an amount equal to 25% of the applicable threshold EBITDA amount. Once the 10X facility begins producing magnets at target levels, in the event that any portion of the magnet production from the 10X facility in an applicable year is syndicated to third-party purchasers, in other words, we're not going to sell to the DoD, we're going to sell to other people, the DoD will be entitled to receive the first 30 million of EBITDA attributed to the 10X facility magnet production that exceeds the threshold EBITDA. So the most you're going to make is 140. After that, the DoD gets the next 30 million of EBITDA. 50% of the EBITDA attributable to 10X facility magnet production that exceeds the initial excess amount on an annual basis in that year. So from 140 to 170, the DoD gets 100% of that. From 170 on up, the DoD gets 50% of all of that. Think about that. Now you have cash flow flowing the other way if it exceeds 140 million. Before the commercial operation date, the DoD will also make payments in respect of certain incremental costs, not costs, but incremental costs incurred by us, including in connection with the engineering, development, and startup of the 10X facility and for designing magnets to the DoD specifications, with such payments being capped at 30 million in any calendar year. So this guarantee doesn't happen until the 10X facility is deemed operational, and then that agreement is only for 10 years. Well, that could be 3 years from now before it starts. Could be 4 years from now before it starts. So the 110, which starts on the first day of the fourth quarter, is important to make sure that MP Materials can stay in business until that date. The DoD offtake agreement prohibits magnet sales to certain restricted buyers and imposes certain other obligations. We also agree to terminate our existing share repurchase program and to cease making sales under the Shanghai offtake agreement. That was the sale to China, which expires in January 2026 and will not be renewed. Financing, this is where it gets interesting here. As part of the financing for the project described above, we sold to the DoD $400 million of newly created Series A cumulative perpetual convertible preferred stock. Cumulative means that the dividends accumulate. Non-cumulative means if a company has preferred shares and it says, well, we're not going to pay a dividend, that dividend simply just disappears. It's not cumulative. They don't owe it to you in the future. It disappears. This is cumulative. It's convertible, which means they can convert into shares. The Series A preferred stock is convertible by the initial holder thereof at any time and from time to time after 45 days of issuance into approximately 13.3 million shares of our common stock. That gives a conversion price of $30.07. Now, two particular things jump out at me here. 45 days? Only 45 days? And then you can start converting? Number two, the conversion price is below where the stock price is now. In other words, you're issuing these in the money. Usually, the conversion price is above the current stock price. And usually, it's 3 years, 2 years, 3 years before they can be converted. Usually the payment on preferreds, which are convertible, usually have a lower yield. This has a 7% yield. What a great deal for the DoD. We're going to give you $400 million. You're going to give us these cumulative convertible shares. You're going to pay 7% on them, not 2 or 3%. We're not going to pay anything for the conversion feature. You're going to make the conversion happen within 45 days, and I want the conversion price to be lower than where the stock price is today. Find me a deal like that. Sign me up. I'll put all my money into that in a heartbeat because I just have to wait 45 days. Why 45 days? Well, it's because you have cash flow that has to go from the DoD to MP Materials to make the floor price of 110. Where's that money going to come from? I get to convert some of my preferred shares into common stock, sell the common stock in the market, and give you the money. Now, it's not the company issuing shares. It's the DoD that is selling the shares to come up with the cash flow to pay for this. So who's really paying for this? The shareholder. The shareholder is promising $110. It just looks like the DoD is, but the DoD isn't. It's just taking the share, telling you what a great deal this is, selling you the share, taking your money and giving it to MP Materials. Look how beautiful that is. Shares of the Series A preferred stock accrue cumulative dividends at a rate of 7% per year. Oh, it gets even better. Compounding quarterly. It's not just annual. Compounding quarterly. And payable solely in kind. Now you may think, okay, so it's a PIK coupon. Who cares? But that PIK coupon is shares that are convertible into common stock that can be sold. Solely in kind through an increase to the stated value of each share of Series A preferred stock. It's a PIK dividend. While the terms of the Series A preferred stock do not restrict the payment of cash dividends by the company within the first 15 business days of each new fiscal year, we will pay to the holder of each share of Series A preferred stock on an as-converted basis cash per share of common stock, representing the amount, if any, by which the annual yield on the aggregate cash dividends paid by us on each share of common stock exceed the dividend rate. So usually when you have something like this, there's usually something in the contract that says, hey, hang on now. If you start paying your common shareholders this ridiculous dividend to keep your share price down, you got to pay us something. Because if there's a conversion price in there, and I say, well, I don't want them to convert, what I'll do is I'll increase the amount of the dividend. And when you pay a dividend, what happens to the price of the stock after the dividend? It drops. You can always keep the stock price down by increasing the dividend. This is just to say, don't you dare try playing this game, because if you do, you owe us that money too. At any time after the 5-year anniversary of issuance, if the closing, this is a forced conversion clause. If the closing price per share of common stock exceeds 150% of the conversion price, the company, this is basically saying the company can force the DoD to convert to shares to stop paying the dividend, but in 5 years. And then you'll find this in any convertible bond, any convertible preferred share. You'll find a forced conversion clause. This is funny, right? Can't force them to convert for at least 5 years, but they can convert within 45 days at a price below the price where the stock is right now. Anybody's antenna up? Anybody saying, wait a minute here, that's a sweet deal for the DoD. It's not going to cost them a single penny, and they're going to get magnets at cost. What a sweet deal. It is. Shareholders going to pay. This gets worse. We also issued a warrant. We just talked about the preferred. We also issued a warrant to the DoD, exercisable at any time, and from time to time after 45 days of issuance for a period of 10 years for up to 11.2 million shares. Now, warrants are usually a long-term option. If a company grants options, the option is usually for shares that already exist. If a company grants a warrant, it usually has a very long expiration time, usually 10 years, and each warrant is for a share of stock that does not exist. In other words, the company would have to create it. However, the strike price on the warrant is usually well above the stock price. This isn't. At initial exercise price of $30.03, the stock price of the company at this time was well above $30. You got warrants for free that were already in the money. And you can start exercising them within 45 days. Such price subject to certain anti-dilution adjustments. In the aggregate, the common stock in which Series A preferred stock is initially convertible and for which the warrant is initially exercisable collectively represent 15% of the issued and outstanding shares of our common stock. So whatever they get, that represents 15% of the shares that are already issued. Go 1 quarter out, the preferred shares get a dividend. Now it's more than 15%. They cannot, at any one time, hold more than 19.9% of the shares, but over time they can sell their shares to fund the cash flow, to fund the operations of this business, and still end up at 19.9, which means this deal could generate far more than 20% of the outstanding shares. The dilution in this is incredible. What you need to get this done is a massively uninformed investor base. An investor base that is either passive or massively uninformed. That is retail. That's what you need, because retail is not going to read the notes. Retail is probably not going to read this. Retail is not going to read the footnotes. Retail is not going to go to the statement of changes in equity and see how many shares were actually created, because the company doesn't have to announce that it's selling shares. It's not selling shares. The DoD is selling shares. In addition to the issuance of securities, JP Morgan and Goldman agreed to provide committed secured financing subject to customary terms and conditions, blah, 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 in an amount equal to, in the aggregate, at least $1,650 million of which will, pursuant to the terms of committed secured financing, be specifically allocated to the construction of the 10X facility, provided that such $1 billion may be reduced on a dollar-for-dollar basis for certain equity and or debt raises, including the proceeds from the offering discussed above, in which they got $724 million. So that billion can be reduced by $724 million. Debt raises and certain unrestricted cash that is not segregated or otherwise earmarked for use as contemplated by the DoD transaction agreements. They're not going to have to provide anything for this, because the cash flows that this is generating from the shares that will be sold to the general public will pay for all of it. In other words, the shareholder is paying for all of it. This is flipping the usual raise upside down. It's backwards. Typically, a company announces a share sale and then at the time announces the deal. We're going to raise shares because we're building this facility and we have a customer. Here, they're doing it the other way around. They're announcing the deal with the customer, but they're not issuing shares. The customer's the one issuing shares. It used to be that the supplier would supply their customer with something and say, we like your prospects, we'll take some ownership in you, our customer. It's the other way around. The customers are now taking an ownership position in their suppliers because they're saying, if you announce this deal, your stock price will really go up. Wait till I tell you what AMD's deal is. 45 days, I want you to keep in mind. This goes against all convention of what a warrant is and convertible securities. 45 days and you can start converting. 45 days for the warrant and you can start converting, and the strike price is already in the money. How come no one talks about that? No one ever said, oh, the DOD deal, they're going to guarantee EBITDA, they're going to guarantee a floor price, this is going to be fantastic. Well, hang on a second here. They're doing it with your money. We also received a loan from the DOD in the aggregate principal of $150 million. This is for the heavy rare earth. Pursuant to an unsecured promissory note maturing 12 years after issuance, interest will accrue at a rate equal to the 10-year plus 1%. So that's a fairly good price. That puts it at about 5.2%, roughly about $7.5 million a year incremental cost on that. So on the next screen, when I do some numbers, you'll see that I add that debt amount on. And then it goes on to discuss a few more things: cessation of shipments to China, factors affecting our performance, etc. I'll let you read that. But we wanted to get the terms of the deal down. Now let's look at some numbers. Okay, let's have a look at some numbers. This is for the 3 months ended June 30th. This is a revenue by segment. And here is the NdPr oxide metal is $25 million. Other revenue, almost non-existent. And the concentrate, which are no longer selling, that is gone. The realized price was $57 a kilogram. And so we can take the revenue divided by 57. We should get 445 metric tons. They reported 443 metric tons that were sold. So we know we're getting 57. If we put the floor price in at 110 a kilogram, now this is from the benchmark, but what I'm going to do is I'm just going to do it from the 57. That means the DOD, because I'm being overly aggressive here, the DOD would have given them 23.47 million. They really wouldn't have. If the benchmark was 65, they would have just gotten the difference between 65. Why would you have a realized price that is lower than the benchmark? Is because you'll have some adjustment when you sell your concentrate to the refiner. There'll be some adjustment for moisture content, and there'll be some adjustment for the transportation from whatever location there is. So the net back you get, the 57 is called a net back. If the benchmark is at 65 and you get 57, the difference represents your deviation from the average or your deviation from the benchmark. So 57. So I'm just going to say, okay, well, let's just assume we don't know what the benchmark price would have been back then. Let's just assume that it's from the realized. What would they have reported instead had the DOD been taking care of this? 23.479. This is for a quarter, by the way. Their Q1, Q2, the first 6 months operating income was negative 43 million. If you add 2 times this amount, you get to almost break even. You get about 3 million. I'm doing rough numbers, back of envelope numbers, so I'm kind of just rounding up. It looks like the price was set to get them to break even very quickly, so that it neither provides them with a lot of profit. Look, we're not going to make you rich, but we're going to make sure you stay in business by getting you to zero. And listen, really, it's up to you to get your efficiency up. Right? You want to make some money, you got to run a business. Get your efficiency up, but we'll get you to zero. Now, this is just their operating income. They incurred interest expense of 5.4 million, and with the new loan, they'll be paying another 7.8 million. So it looks like the floor price is meant to get them to an operating break even. Interest expense, if they want to cover that, they're going to have to get their efficiency up. It doesn't seem unfair to ask management to run an efficient business, so okay. Let's look at the EBITDA. They want to do mine to magnet, which means stage 1, the mining, stage 2, the refining and separating, stage 3, the production. So costs are incurred here, costs are incurred here, revenue is generated over here, mine to magnet. That does not mean mine to concentrate and revenue from concentration. They even say in their 10Q about this that as they ramp up, their revenues will primarily come from sales of magnets. Like concentrate will be nothing. They don't say zero, but they say will be immaterial compared to what we'll get. Mine to magnet. So all the revenue is going to come from magnet sales. They're being told, look, we'll guarantee 140 million of EBITDA for 10 years. Remember, you have a 29-year life of mine. So if we have 29 years based on their 2P reserves, and they take 3 years before they ramp up to full production, they get to year 13 of this guarantee. After that, it's all on them. All of these payments go away. It's all on them after that. The expectation is, well, if you have good management in place, you should have an effective running facility after that period of time. But the current administration ends over here. If it takes 3 years to get here, the current administration ends. You may have another administration that has a different idea of how to deal with China, and maybe the next administration finds a better way to deal with China, and everybody's friends again. Maybe China shifts its production such that it does become friendly at that point in time. But there's no guarantee it's going to last that long, because it has to last over multiple administrations. The average multiple of EBITDA for a mining company is anywhere between 8 and 12, depending on what it's mining. You know, for like something like silver, gold, copper, they tend to have, pushed to 10 to 11 to 12. The more efficient the mine is, the longer the life of mine, the higher the EBITDA. 14 is really, really pushing it. Really pushing it. This is a small mine. And if we say, yeah, but listen, you're going all the way to magnet production, and you have the DOD guaranteeing everything. So you basically have a 10-year annuity within a 20-year life. It's got to be worth something. Let's go really aggressive and give them a 20x. And just assume it's for the whole time period and give them a 20x. Because remember, above 140, they lose the next 30, and then they lose 50% of everything before that. And it doesn't start until they get completed, and it ends after 10 years. But I'm just going to go ahead and just say, well, let's just say it's going to be 140 forever, and give it a really ridiculous multiple of EBITDA for a mine, 20 times, $2.8 billion. Because 140 million in EBITDA a year, that's not a lot. When you look at some of these other big mines that are generating 1.4, 1.5, $2 billion a year, 140 million's nothing. They currently have a market cap of 11.17 billion, and I'm being really, really generous at 2.8 billion. They're about 4 times, they're valued at about 4 times more than what they truly would be worth. And this is assuming you're going to get the 20 and assuming you have good execution. I don't think so. I sold November $80 calls at 270 a while back. As I started looking into this, I thought, wait a minute here. On a fundamental basis, it does not belong at 11.17 billion. Fundamentally, this is wrong. So I went ahead and I sold some calls. They're now $1.09. I am going to close those, because I am playing the wrong game. Now that I see the cash flow, I'm playing the wrong game. So let me just impress upon you what is going on here, just so that you really truly understand. AMD and OpenAI did the same thing. AMD gave OpenAI warrants for 160 million shares. Do you know what the exercise price on those warrants are? 1 penny. 1 penny. OpenAI would have to pay $1.6 million to AMD, and it would get 160 million shares, of which are, what, 200 and some odd dollars a share? And on the announcement, what happened to AMD's price? It went straight up. So what happened to the value of the warrants that OpenAI has? They're worth billions. So what is going to happen with AMD is it is not time-based. These warrants vest performance-based. So sometime in 2026, they have to complete the purchase of a certain number of chips, of which they're going to do. They're going to do it. And AMD is going to get paid for it, because OpenAI is going to take these warrants over to their banker and is going to pledge it as collateral for a loan against the purchase of these things. And as soon as they purchase these things will vest, and those will be sold to the shareholder. The shareholder is going to pay AMD, not OpenAI. The shareholder is going to pay AMD. Now, let's just do a balance sheet. And let's just do an income statement. When a company sells stock, it gets cash and it gets equity. So its cash goes up. This is liabilities here. This is equity. And its equities go up. The income statement is untouched. But what if we could sell shares and book it as revenue, not capital? What if we could issue shares to buy stuff, and the proceeds we get from selling the shares would be called revenue? And the revenue would be so good that our valuation would go up, because we have great revenues and great earnings per share, that we could do it again, and we could sell even more shares and get even more revenue, and our valuation would go up. So we could sell even more shares and get more revenue. Well, you can't do that. You're selling shares, you're raising capital. You're not selling product, it's not revenue. But what if you're not the one doing it? So under this deal, here's our balance sheet. Here's our income statement. Is we do a deal like this where I'm going to give you warrants for shares and you're going to buy stuff from me. So you buy stuff from me and I have revenue. Look at that. Isn't that beautiful? Now this is AMD's, or you can call it MP's balance sheet and income statement. They have revenue because the customer is the one providing the revenue, but the customer is the one that is selling the shares now. Selling the shares that the company gave it through warrants that were in the money. So the company, the customer sells the shares, takes the money, gives it here, and there's revenue. This revenue trickles down to net income, and this net income ends up over here and over here. This is what you would get. This is what you would get. But we're cycling the capital through the income statement first over into shareholders' equity, as opposed to just shareholders' equity. We're passing the share sale through the revenue, through the income statement. The company's not the one issuing the shares. The customer, isn't the one selling the shares. The customer is selling the shares to pay for the product, to derive the revenue that the company is getting. But the company gave the customer the warrants that were in the money and the ability to then convert those warrants into shares, to sell those shares, to raise the money, to pay for the product that they're getting. And in paying for the product that they're getting, their EPS goes upwards. And since their EPS goes upwards, their valuation goes upwards, which means the value of all of this goes up, which means the more they sell, the more they can buy. Isn't that beautiful? That's what you have with MP. Is the DOD is guaranteeing $110 as a floor price, so that they don't have to raise money through debt or equity to cover any operation loss. The DOD will cover the operating loss by selling the shares into the open market to the shareholder. DOD gets the cash, but DOD is not MP, it's the customer. DOD then transfers that to MP under the contract, and MP says, well, that is the difference between, that is the value of our swap. Our swap is paid off, that is revenue. And that revenue will filter down into retained earnings. as opposed to selling shares to cover our loss, we'll have the DoD sell shares to cover our loss. Because most retail investors aren't going to look at the statement of changes in equity. They're not going to read the footnotes. They're not going to dive into the details of anything. They're going to look at the big picture. Here's what's going to happen with MP. And there is a beautiful trade here, a beautiful trade of which, if you have the applied level, Sunday night we do the Globex pre-open at 6:30. I will lay out the trade at 6:30 on MP because they have earnings on November, I believe it's 6th, which is Thursday. They're going to have earnings. There's a beautiful, beautiful trade set up over here. Here's what's going to happen. They're going to report, and their Q3 is going to be just garbage because they aren't selling any concentrate. They're stockpiling. So what are we going to see for inventory? We're going to see inventory skyrocket. We're going to see revenue really drop. We're going to see cash flow from operations really drop because you have this build-in inventory, which is a use of cash, and you have no revenue to begin with. Fundamentally and financially, it's going to look ugly. Guidance. Q1, October 1st, the DoD starts transferring money to MP. They are profitable right away. Their guidance, the guidance is going to be everything. Have you ever seen anything like that? This is interesting now, where you can raise capital and call it revenue. You're raising capital and calling it revenue. It's in the structure of the deal. You go to somebody and you say, hey, listen, do you want to be my customer? I'll show you how to get our product for free. Or you're a customer and you go to a supplier and you say, hey, do you want to sell me billions of dollars of product and write down billions of dollars of revenue? I'll show you how we can all get that done for free. Now, who suffers here? Well, of course, the company has dilution. The company has dilution, but it doesn't care as long as valuation keeps going up. If all of the dollars from your capital raises are revenue, your EPS is going to grow at a fantastic rate. Your valuations are going to go up. Isn't that all you care about? Isn't that the job of management, to maximize the return to shareholders? And aren't you maximizing the return by raising the price? Oh, all this will end at some point. At some point, all this will come crashing down and it will be obvious and fingers will be pointed and people will be blamed. But when you have a large enough retail crowd that pays attention to the headlines, that pays attention to the stories, you have a story-driven market, and this is what we have. And this is where the deals are happening. Capital raises our revenue.